Excellent. So hello and welcome today to From A to Z, Canadian Crowdfunding Chronicles. And I'm Victoria Bennett from the Crowdfunding Hub. And I'm pleased to introduce you to two successful players in the Canadian equity crowdfunding market to discuss the differences between Canada and the US and the opportunities and benefits. First off, I'd like to introduce you to Alexander Morsink. He is co-founder and managing director of Equivesto, an equity crowdfunding platform that has just hit $34 million raised. And I would also like to introduce you to Connor Yuen, who heads up a VC fund and has successfully raised over $1 million for a vertical farm that he then took public. So welcome, gentlemen. So
thank you very much for having me.
You're very welcome. So I'd like to start with your personal experience with equity crowdfunding in Canada or the US, because I know, Alex, you've sort of had relationships down there as well. So Connor, do you want to start with your experience first?
Yeah, absolutely. So, and Victoria, you were the one who's actually was kind of side by side with me on my real first crowdfunding experience through our vertical farming company, which was great. And, we worked with a company called Front Funder. Victoria did a phenomenal job on helping us be able to build up and gear up our campaign towards really getting the message out and trying to, tell the story and find those right investors and those right people who not only wanted to make money, but also believed in the vision and the long-term story of the project. And, it went really, really well. We kind of, I didn't know anything about crowdfunding before. And that was kind of how I was introduced to Victoria. And through that process, we've built a phenomenal relationship. We raised $1 million, which went really, really, really well. And I can get into more details if you have any other questions, Victoria.
Yeah, no, I think a couple of things to be interesting is really where you went from there. And also, I think what would be interesting for the Americans on this call is what your offering was, because I think those two things are probably very interesting to the people on the call.
So you mean the offering as in what the deal was, or
yeah,
of the company itself?
Yeah. So I'm thinking,
okay.
Well, I'm trying to guide you towards things like the common shares and warrants, because that's quite unusual in the States to offer shares and warrants. So
so when it comes to structure and raising money here, guys, we have 10 times less people than you. So we have to get really creative when it comes to our offerings and what we give to people. But, ideally, how we like to structure it to give people the long-term vision for it is to add warrants together with common shares. We do it together in units. How we offered it was 15 cents a share of common shares at the time, followed by a 30-cent warrant that was valid for 2 years. And that gives them an opportunity. Number one, Sorry, was there a question?
Oh, I'm sorry. I thought I didn't realize I said that was good.
No problem. Yes, 100%. And the main purpose for that is to get people, thinking about the long-term vision of the company. If we can be able to have every investor become more of a strategic investor and help us be able to get to that higher price point, it's in everybody's favor to do so. So we decided to allow people to give them an opportunity to not only just be shareholders, but be future shareholders, and to have that at the best price that we could offer.
And I mean, that was one of the key things, was also you were able to get, so in Canada, if you want to be on the public exchange, you need to have a certain number of shareholders. And I mean, that was...
Yeah, so I'll take that really, really quickly. So just being public in Canada, you need a minimum of 150 shareholders. And in order to get that, a lot of different companies, what they'll do is they'll hire distribution groups to hire people to call just to get $100 per person for 150 names, just so they can get enough shareholders to be able to go public. But through crowdfunding, because the majority of the shareholders have smaller investment sizes, you have the ability to be able to invest off your debit card or your credit card, and you can invest from anybody. You don't just invest from accredited investors, where I've always raised the majority of my money from, or close friends or family. But you could literally stand on the middle of the street, and if you have a big sign and a video that's playing about how great your deal is, you could literally sign those subscription agreements with people walking by the door. So, to have the ability and flexibility to be able to have anyone invest in your company, gives you the opportunity to leverage all people as well as ads in some spaces, which we can chat about later too.
And exactly. And I think that's for anybody from the US, they're going to find that quite freaky. And we'll probably talk about that you can actually advertise, because that's not the norm, or not so easy down in the States. The other thing I just pull out from that, just as a bit of a comparator, I mean, Connor mentioned 10 times more people in the States than there are in Canada. The other thing is 3% of the population are accredited investors in Canada. So 97% of the population you normally don't have access to. And we can do blended deals. So we can do accredited investors and retail investors in the same campaign. And people like Alex, and I will let you speak in a moment, Alex, can actually help that out. But the other thing that we can do in Canada, or difference is because you have 12% accredited investors down in the States. So, you've got a much bigger pool, more people, but more super wealthy people that you can
Their
dig into.
Their 12% is more than our 100%, Victoria.
Yeah. Yes. Good point. So
yes, but I want to add something. Less than 3% actually invest in any entrepreneurs. So there may be more that qualify by a W-2, but less than 1.5% of those people making over $200,000 invest in entrepreneurs. There's only 350,000 people in structured angel groups. And last year in the US, only 350,000 people invested in Reg CF. So there's a big, and that's the education problem that I've been addressing.
But it might only be that. It might not be a population problem. It might be an education and sales ability problem. So that's something that you guys have, this hidden gem that a couple of them actually, that potentially we're leaving under rocks. So the better we can market that strategy, the more I think effective that you guys will see the result.
Yeah, absolutely. So Alex, do you want to provide your overview from a platform point of view?
Certainly, yeah. The Canadian space is interesting. There's some ways where it's quite similar to the US, but there's a number of ways where it's quite different. So obviously, equity crowdfunding first came about in the US with the Jobs Act, and then finally there were some modifications to the Jobs Act that allowed the general public to participate with Reg CF, and that was around 2016, if I'm not mistaken. So in Canada, I think, my perspective might be a little bit more from the regulatory standpoint, because I run one of the few equity crowdfunding platforms in Canada. And so regulation is a big part of that. But in the United States, there's one securities regulator, the SEC. They regulate the entire country. In Canada, securities regulation is done on a per province and territory basis. We have 13 provinces and territories. And you're going to say, wow, that sounds very strange. The States is all about states' rights, and they've got one regulator for the whole country. Canada doesn't really give two shits about the provinces, and it's every province has their own regulator. And so what that does, and the regulators also don't get along very well. There's a little bit of an ego game that sometimes gets involved. And so the rules that came about when Canada tried to bring equity crowdfunding around in 2016, same time as Reg CF, is the rules were created differently in different provinces, and the rules didn't match up. And so what that meant is, if you wanted to equity crowdfund as a business based in one of the provinces from all across Canada, you had to try to follow 13 different sets of rules at once that sometimes contradicted each other. It's a bit of a mess. And so finally, through a lot of sort of working and with some feedback actually from myself and Equivesta directly, the regulators were able to implement a new unified national set of crowdfunding rules in September of 2021. So we as a business actually got our license to operate a platform partway through 2020 in the middle of the pandemic, but it wasn't really until September of 2021, when these new rules came out, that it was actually possible to effectively do equity crowdfunding. So it hasn't been very long that there's sort of been really successful equity crowdfunding in Canada. But in terms of the sort of main similarities to the US, We have a sort of equivalent, that new set of rules from 2021 that I mentioned, that would be equivalent to the Reg CF in the US. So it's smaller companies, you can raise up to 1.5 million every rolling 12 months. In Canada, through Reg CF equivalent, it's called National Instrument 45110 Startup Crowdfunding, nice and long. Under 45110, you don't actually need financial statements of any kind, but really they're both designed in the same way, which is to allow the general public to invest smaller amounts into early stage businesses. While the US has Reg D to bring in the accredited investors, in Canada we have something called the accredited investor exemption. So typically you do sort of two campaigns blended at the same time. So you'd have the crowdfunding campaign to take the general public investors, and then you'd have the sort of accredited investor campaign to take the accredited investors on at the same time. And I don't want to take up the whole hour just on regulation, Victoria, so I'll pass it back to you.
Yeah, no, I mean, I think, you gave a really good overview there. The one thing I would say, though, is prior to any crowdfunding regulations in Canada, we did have the offering memorandum. And that was one of the ways that retail investors could get involved. And so we have had that sort of process in place for 20 odd years. It's just formalization is more recent.
Certainly, yeah. The offering memorandum I would describe as similar to a Reg A in the United States. So you can raise much more money, but you need audited financial statements and you have to do ongoing reporting to the regulators. So there wasn't that sort of easy access route for startups like there is now with National Instrument 45110, but there was sort of always an avenue that existed to take the general public. But in terms of legal paperwork and preparation, that doing an offering memorandum costs typically around 100 to 120,000 in legal and audit work before you'd even start seeing any money.
Yeah. So Connor, I was just wondering if you could talk about the Canadian regulations that you raised under, if you can remember back.
Specific to which area, Victoria?
Well, I mean, I know you, because at the time you could only raise up to 500,000, but you raised over 1 million. So how you managed to do that?
I think it really came down to, our efforts in putting together the great story. I think it really came down to us being able to show the general public by investing in our company how they're actually participating in a major change. And, whether that's to the crowdfunding, maybe that's a little bit to Victoria, because she was a big help on a lot of that stuff. But really, I think that we built a phenomenal story around the fact that people wanted to get invested in the long-term vision. Now, the regulatory side of it in Canada, like Alex spoke to, yes, you have all different types of regulators across all different provinces. They are not as motivated as the SEC is, to be honest with you. But at the same time, it doesn't mean that you ever want to do anything that's going to put your company in a tough situation. So by leveraging crowdfunding, by leveraging the ability to have that exemption for your company, you tie off all of the loose ends for any kind of future headaches or future problems, but at the same time open up your market to everyone under the sun. And even just to the point that Victoria made before, imagine being able to actually have a great deal, I'm sure that everybody who lists their deal and gets qualified on these crowdfunding platforms has, but being able to have this great company access 100% of the population and at the same time be able to add it all over Facebook, Instagram, and anywhere else in the world. So,
and now we use TikTok quite a lot as well. So, which we didn't do in your day, Connor, because TikTok really wasn't a thing. But I just wanted to sort of probe in because, you're a VC, Connor. So now, sort of, you were before you've gone this, but your background's VC, and one of the things we often hear that VCs don't like messy cap tables. So you used a voting trust agreement. Do you want to talk about how that works, and how you found the voting trust agreement, and both from somebody raising capital, but also from the VC side as well?
Victoria, I'm going to need you to jog my memory on the voting trust agreement that we used on that deal. I'm sorry, I've done just quite a few things.
You've been busy since.
I just wanted, just so I answer it correctly. Yeah. I don't want to do something wrong.
So typically in the US, and I'll get Alex to speak to that, you use special purpose vehicles, but you don't use special purpose vehicles in Canada. Usually you have a separate class of shares that's non-voting, and those people in the, so you only have one line in your cap table, so clean cap table, and then you have sort of an extra tab, which is everybody who's got the separate class of shares, and they are under a voting trust agreement, so they sign away their right to vote. But there's usually somebody from the C-suite who actually owns that share.
Yes,
It's just if you're investing, $250. Yeah.
I'm sorry, Victoria, I totally remember. Let me speak to this. So yes, thank you for jogging my memory. So with the way that we did it, we had a voting trust agreement because of the fact, yes, they don't want to see all of these tiny little shareholders all over this cap table. It looks like there's a lot of loose paper lying around, especially for companies going public. They are worried that there's this many shareholders. You don't know who to call if shares start selling. There's so many different people. If you get to an AGM and there's like a real serious thing happening, like an asset sale or maybe an acquisition, you're going to need those votes. So under a voting trust agreement, how we did it was basically every single investor that invested through crowdfunding and did a voting trust agreement with myself that I had their proxy automatically to vote in whatever direction was needed.
Yeah. And Alex, from your point of view, because you're the one who's actually implementing that, how do you find it?
Yeah, so I think that, there's a number of different reasons why you sort of would go down that path. The Canadian regulators, when setting up the rules, didn't want to create an accidental loophole where people could essentially do SPAC style raises for private companies, and they didn't want to create an opening where people could essentially raise investment funds without having to go through the regulation to become an investment fund. And so in the rules for equity crowdfunding, they specifically said you cannot raise capital into a company whose only purpose is to buy other assets or securities or anything like that. And so what that accidentally did is it removed the ability to create an SPV, like is common practice in the US. And so using this sort of non-voting shares and the voting trust combo, the idea is really to, as Victoria and Connor have said, avoid creating a messy cap table, but avoid creating challenges from a management perspective of the business. One thing that people sometimes are unaware of or overlook is even if people have non-voting shares, a share class as a whole can still vote in certain scenarios when you're modifying corporate structure, changing the shareholders agreement, things like that. And so when you're taking on hundreds of additional shareholders, even if they have non-voting shares for the majority of votes of something at, like an AGM, in a unique opportunity where, like Connor mentioned, there's an asset sale or you want to IPO or something like that, you would need their sign-off. And having a voting trust removes the need to go out to all those hundreds of people because they don't have voting shares. It's not like, when Connor was having them all signing the voting trust, like that Connor also got an extra 20% voting rights or something like that. They don't have voting shares in the first place. So you're not changing any of the voting structure or control, but you're simply setting it up in a way where you're basically having all the people come in as truly silent partners, and you're avoiding making a messy cap table. So the idea is it makes it very easy for companies to then go and do future rounds with other more sophisticated investors as well.
And let's turn it around the other way. If you've invested $250, you don't want to be bothered every 5 seconds. It's a two-way street.
Right. We find most of the investors, participating through our platform are interested in supporting businesses that they care about. They're excited about the opportunity to invest in these early stage companies, but they're not looking to sort of get involved in management. They sort of want an email update every couple of months and, hopefully they get some money out at the end.
Yeah. And before anybody here starts to panic, this sounds complicated. This is what Alex does and his team does is they manage the voting trust agreement, they manage, assessing what we call KYC, know your customer. Is this person accredited investor? We use this regulation. If this retail investor, we use this regulation. So it all happens seamlessly. So just if you're thinking about raising in Canada, don't panic. You're not going to be stuck there trying to work that all out.
No, exactly. The idea is to try to make it as straightforward and simple as possible for both companies looking to raise capital, but also investors who want to participate. A large difference between Canada and the US is in the US, equity crowdfunding platforms are their own sort of subcategory. So if you go on WeFunder or Start Engine, they're really just doing sort of equity crowdfunding deals. Whereas in Canada, there's not very many platforms operating. I'd say there's maybe 3 of us that are sort of operating in the space. But those of us that are, we're licensed as something called an exempt market dealer. And this is a full securities broker dealer license. So technically it's the same license that, a boutique investment bank or something else like that would be using. And so the breadth of the type of activities that we as a platform can do for companies are quite broad. So we're not, for example, limited to only raising the 1.5 million as outlined under that crowdfunding rule in Canada. We can raise 50, 100 million, 300 million for companies through any sort of variation of securities laws that exist. But also at the same time, we're using all of those things to try to smooth the process out as much as possible. So working with the issuers, our main objective is to try to help them understand how to approach raising capital in this way, but also make it a lot easier. And then from the investor perspective, it's not purely a listing activity. So whereas in the US, you could sort of show up, put in a little bit of information, hand in your credit card, and you've made the investment. In Canada, because we're securities dealers, we actually have to complete a full sort of know your client and suitability assessment on every investor who signs up. So imagine you're opening a new investment account at TD Bank or Wells Fargo. That's the same experience that we have to do for every client. So even if you're signing up to put $100 into Connor's business, we still have to ask, okay, are you married? What's your spouse's name? Where do you work? Do you have any kids? Have you invested before? What's your investment knowledge? What's your risk profile? And then set individualized investment limits for each person based on your income, assets, and things like that. So even with all of those responsibilities to protect the investor, we're still trying to, and I think we've been relatively successful in creating a process where, sign up and approval should only take about 5-6 minutes to complete.
Mm-hmm. Yeah, I agree. But we just always prep people to know that it's not like buying a book on Amazon.
No, sadly not.
Yeah. Let's talk a bit about the sort of investor communities and how they differ in Canada and the US when it comes to equity crowdfunding. Are there any distinct preferences, expectations, investment patterns? We've talked about the difference in accredited investors number-wise and heard some insight on those as well. What are you seeing, Alex?
Yeah, I think it is really quite interesting. I think, the US is much larger, and equity crowdfunding has sort of been firing on all cylinders since 2016. But even when talking to, so we partner with WeFunder for a number of deals, and so we know that team in the US pretty well. Even when talking to them, they're still saying with over 1 million investors on their platform that companies need to expect to attract 70% or more of the money that they're looking to raise through their own networking and community building activities. We would see something quite similar in Canada. So even though there's tens of thousands of people on the different platforms, we're always very upfront when talking to our clients and say, you will need to plan to attract 100% of the funds you're looking to raise through your own community building, networking, marketing activities. And we try to help them do that, free marketing education, mentorship, connecting them with great partners like the Crowdfunding Hub so they can get, paid professional support in that area. But really, I think that was one of the biggest lessons that we learned quite early on launching our platform is while there are some people interested in investing in early stage companies like angel investors who want to get involved, really the vast majority of people who are going to be providing their money to these raises are going to be individuals drawn in by the company itself and the founder and that journey and that story. So focusing on that and building a strong community around the individual business is really going to be a core factor to success. with the current sort of market change that we've seen in both Canada and the US, there's been a bit of a pullback from the venture space and somewhat from the angel space. And so there's a lot more companies considering equity crowdfunding as an alternative funding source. But as an angel investor myself, what I've also been seeing on the angel side, which is pretty interesting, and I'd love also to get Connor's opinion on this as a VC, we've actually seen a number of angels who still want to participate, but want to participate in smaller check sizes. And so instead of writing check sizes for 50 or 25,000, they want to do 10 or 5,000. And, once you pass that $10,000 kind of barrier, that's where you start to enter equity crowdfunding territory. And so we're seeing a lot of companies consider leveraging the equity crowdfunding rules, but really they're still just doing an angel investor round. They're just using the equity crowdfunding rules and the equity crowdfunding structure to allow many more angels to participate in smaller check sizes, as opposed to, getting $100 or $200 check sizes from the public and getting, thousands of investors. It's still $5,000, $10,000 check sizes, but it's from, 50, 100, 200 angels.
Mm-hmm. Maya, you had a question.
Yes, I do. So I've got some familiarity with this space that you're talking about. I'm wondering if you think that this might be driven by the rapid increase in accelerators and incubators, and this notion of put together 5 or 10, join the accelerator, these sort of pitch competition type concepts. Yeah, go ahead, Victoria.
Can I answer that one, Alex?
Yes, please.
I think one of the biggest challenges that we have, and it's something that we're actually working to address, is most incubators and accelerators only suggest angels or VCs. And so that's why. So when there are companies that really should be using equity crowdfunding, it's not even on their radar. And so I don't know if you listened to Kathleen Minogue's talk earlier, but she's doing a training program in the US to all the incubators and accelerators. And we're looking to do exactly the same in Canada to train every single incubator and accelerator on equity crowdfunding, so that anybody passing through, they can identify which companies are a good fit or not. But I think that's the reason they're doing it, is because that's the only route they're told. I don't know, Connor, Alex, if you have a view on those.
Certainly, Connor, do you have a comment? You want to take a stab at that first, or would you like me to go ahead?
By all means, you can go first, my friend.
Yeah, so certainly I'm not a VC, but just from my perspective in the Canadian space, a lot of the actual limited partners who participate in Canadian VC end up being sort of larger corporations or government related entities in some way. There's not as many actual individual people, limited partners who participate in VC. And so it's not like there's suddenly a bunch of investors who could be sort of going in directly. Karen, you have thoughts on that? Oh, I think she just froze there.
Well, a big reason as to why we have our fund, at least initially to start with in the first place, is because we almost acted as a crowd raising platform for the companies that we were investing into, because a lot of our investors were not accredited investors. So we needed a platform to how they could be able to invest, and we would get involved in these companies, become directors and get involved in management, and then they would invest through our venture capital fund in that way, allowing them to participate in these projects. So that's how we did it before I met Victoria. So
excellent.
Do you want to talk a bit about the sort of common shares versus preferred shares? Because I know that's one of the just a couple in common shares versus preferred shares, and then also the amounts that typically are invested, especially with non-accredited people.
Yeah, certainly. Preferred shares, if we think about if we remove equity crowdfunding in general, and we just think about a typical sort of the funding landscape and a company going through sort of standard family and friends, angel, VC, later stage VC, private equity, go public. Typically, you have preferred shares really show up when you get into the later stage VC and private equity firms who are looking for preferential treatment when it comes to exits and things like that. With equity crowdfunding, and obviously you'd have common shares sort of in the mid-range, and then you would have potentially a SAFE or a convertible note even earlier than that. With equity crowdfunding, we typically do a non-voting common share, which is not necessarily very standard prior to us sort of pushing it into the space. Normally, common shares get voting rights, but no dividends. Preferred shares get no voting rights, but they get a dividend structure or some sort of other preferential treatment. Really, the idea behind the non-voting common share is you want people who are in it for the long term alongside the founder and are sharing in that longer term capital sort of growth journey. But at the same time, you don't necessarily want to over encumber things by providing the voting shares. So we introduced that non-voting common share to sort of drive that, and we're seeing that perform very well. With the current market change and the sort of collapse of the VC space a little bit, we're starting to see more companies considering doing some sort of fixed dividend through a pref share type structure. Some of the investors are not as interested in going for the sort of moonshot tech-driven startup like they were before. And so looking at other still early stage companies, but maybe more of a small business or a commercial business as opposed to a startup style company that's offering pref shares with a dividend or something like that is really starting to pick up in interest, certainly at least in Canada.
Yeah. Great. I think next, Connor, can I ask you about, the all common shares? You had common shares, you had warrants, but I believe you also had TFSAs and RRSPs. You might need to explain what those are to anybody from south of the border.
For sure. So in Canada, we have RRSPs, which are retirement savings plans. And then we also have tax-free savings accounts. And these tax-free savings accounts basically allow you to be able to leverage investing in specific companies that are TFSA or RRSP eligible, and to being able to invest into them and to have basically zero tax or zero capital gains, zero tax once you sell those positions. So, that's it's great for Canadians, and for us to be able to have access to being able to have specific trusts and groups that we can work with that can get our companies eligible for TFSA. It makes them that much more of an attractive investment perspective. And the reason why is because people know that they're not going to be paying these large 50% capital gains taxes and all these different things are going to come through. They're whatever they make on this, they're going to make it, they're going to keep. So being able to have a company that's TFSA eligible in Canada and leveraging crowdfunding around that is huge, because every Canadian citizen gets an additional $5,500 a year that they can contribute to their TFSA. And I believe that number is correct. If you correct me if I'm wrong, correct.
No, you're right on the money there, Connor. The whole benefit to all of that, and where it's been great that there's been more TFSA and RRSP sort of inclusion, is initially those were really only for public investments. So mutual funds, stocks, bonds, sort of already on a listed stock exchange. And there wasn't really much accessibility for private entities to be able to allow people in through those doorways. But there's certain other financial institutions called trust companies that basically can allow and help manage a TFSA or RSP or other registered account to allow it to be invested into a private enterprise. So it takes a little bit more paperwork, as I'm sure Connor remembers. But if you go through that work and sort of get that all set up, you can, allow the investors to take advantage of these tax deferred or, tax avoiding investment accounts.
It does a couple of things actually, because crowd raising actually takes quite a bit of paperwork as well. So I don't want to down on that, but in any way, so that takes paperwork, that takes time and effort. But when you put the time and effort in one area, you might as well put it in all areas. And that's what was great for us though, because after going through crowd raising, going through getting qualified in all these areas, by the time we came to list on the exchange, we didn't really have much work to do. All I did was hand over the file folder and it was ready to go.
Fantastic.
So it really gets the companies ready too. That's the really good part, is that if you're actually qualified for crowd raising, you know that they've went through an extensive due diligence process to ensure that this company actually has some legs on it, which is huge, because a lot of public companies in Canada, they don't actually go through any due diligence process at all, and they're still listed on the companies, and then still people lose tons of money. So I would actually rather invest in a crowd raising platform than a random junior market company or mining stock. Just to give you an example.
Mm-hmm. And to that point, I think one of the other differences, I think I'm correct in saying there's a legal requirement of an annual report in the US, but there isn't in Canada. So although there is quite a lot of stuff to go through on from a due diligence point of view, and that's what the platforms will walk you through, I think there's still, I don't know, Alex, if you want to talk about what you do and don't have to do north and south of the border.
Yeah, I think that's one of the sort of the main differences that catch people's attention. Even to do, a Reg CF, you have to prepare financial statements with an external accountant, and you typically have to get them audited. Whereas with National Instrument 45110 in Canada, you actually don't have to provide financial statements at all, and they can be internally prepared financial statements. So you can avoid an entire expense of an audit and everything like that, which can be a very sizable saving. One thing that I would note, which I think is important to keep in mind, with equity crowdfunding and any securities law is really governed where the individual investor resides, their place of residence. And so, for example, if you have a company raising on a US equity crowdfunding platform, that raise is structured and governed by US securities laws, and American investors can make use of that securities law. But for a Canadian investor to want to invest in that US offering, they would be governed by Canadian securities law, and Canadian securities law would not allow them to participate in a cross-border investment like that. So US companies raising on a US platform cannot take money from technically anyone outside of the United States of America. And Canadian companies raising on a Canadian platform cannot take any investors other than those living in Canada. So it is highly siloed based on geography. And, Canadian companies, even if a Canadian company went to the US platform to try to get American investors, and they're like, okay, we'll just use a US platform to do it that way. The US laws around equity crowdfunding actually don't allow companies that aren't domiciled in the US. So it's really American company, American platform, American investors. And then in Canada, it's Canadian company, Canadian platform, Canadian investors. Yes, Mia, you have a question.
It's Maya.
Maya, I'm sorry.
No worries. It happens all the time. We heard in the pitch presentation earlier today, a young woman with her business based out of Texas, and she said that she'd received investors from outside of the US by a subsidiary company. So have you experienced instances where Canadian companies have set up subsidiaries inside of the United States in order to raise on American crowdfunding campaigns, or vice versa? Have you seen American companies set up subsidiaries? And a corollary to that question is also this idea of a holding company. Like I've also seen like Copies, for an example, doing this model of the holding company too. I'm curious about that for cross-border traffic.
So you can certainly get very creative in doing things like that. And we're happy to sort of engage in those conversations. I would note certain US platforms don't like going in that direction as much anymore. So WeFunder, who's sort of the partner that we work with more frequently, they have been more resistant to the idea of somebody just setting up a subsidiary company in the US simply to make use of the platform. They want any money that goes into US crowdfunding via a platform to be spent in the US. So rather than just setting up a sub for sort of moving the funds around, they would want, okay, your US operations will be done out of the US entity, and you'll value the US entity separately. We've actually explored doing a sort of combined warrant or stock option. So you invest in the US entity, but when the parent goes public, your shares automatically convert to the parent company's stock. And so, or if it gets bought, it converts as well. So it protects you. We haven't had a client take up that offer just yet. So
I will I will say that I'm finding that with women in femtech and in
Mhm.
manufacturing, so energy, a lot of climate tech,
Mm-hmm.
what they're finding is that they're expanding out into the US, the UK, Australia, New Zealand, some of these spaces where there are more progressive climate legislation, which is
Mhm.
driving market demand. And so
Right.
I've been wondering whether it's possible to do this sort of sequential kind of crowdfunding that allows them to then expand into each market using a crowdfunding campaign as their first round of financing to get into that market.
Yeah.
Yeah, I think
You
that's a very
certainly could.
interesting
You
model that
certainly
you're
could.
exploring. Yeah.
Yeah.
Okay.
Yeah. That definitely.
It's so
that
funny
definitely
you
works.
say that. Either great minds think alike. I was just about to get you to talk about that because it's such a fundamental question. And just, it's residency. So for a Canadian platform, if you're an American living in Canada, you've lived in Canada for 6 months out of the last 12 months, you can invest in a Canadian company. So, that's the sort of thing that the Equivesto team
Exactly.
works out. So
exactly. The other thing I'm curious about for Connor, since I think I heard that Connor was mentioning that he's based out of BC, there's the BC tax credit, also the 30% tax credit, but that seems to be only if you're sort of that frontline investor outside of any special purpose vehicle or any sort of conglomeration. So Connor, you want to speak to that because you're shaking your head no, because like I've got a couple companies that came and said, hey, we need a first check in order to get that BC accreditation.
So you need to show a first set of shares being issued. I've done it a couple times on a few companies. I'm trying to don't hold me to this. So I don't know every single rule, but I know I needed at least 25 grand invested, shares issued for that.
Right.
It needs to be a technology company of some type.
Right.
Typically.
Yeah, I've done it with 2 ed tech companies specifically.
Yeah, and you would get 30% back. Now there's a model on how to do this. All right. You get the business EBC qualified.
Right.
You make sure that every BC resident gets the 30% back. As a corporate entity, you get a 30% tax credit, eligible and usable for, I believe it's 4 years. Now I can double check that one. I would encourage all of you to do so. Then what you would do is you also get the business eligible for crowd raising. Then you get the business eligible for TFSA and RRSP. And
that is what I'm hearing you say. I put those pieces together very quickly because it's very clear that what you can do is start with that EBC, then go to crowdfunding, then go to TFSA. Then you can use that to unlock the Jenga puzzle of grant funding, right? Because you've got this matching grant funding system in innovation funding.
I have 50 seconds left and I'm have a counter down right in front of me. I'm going to lay this to you guys really, really quick. You get it EBC qualified. You put in 100 grand, you get 30% back. That means you have 70,000 put in, you have 100,000 in equity. At that point, you crowd raise, get the business eligible crowd raise, get all the people involved. TFSA eligible, you put the 70,000 or 100,000 in shares that you paid 70 grand for in your TFSA. Even as a private company, the fair market value in Canada, even as a private company, if you close a round, it will increase the size of your TFSA. If that company is to go public, before it does, you flip over to the RRSP to get an additional coupon back. And then when you sell the shares, you flip them back to the TFSA to sell them tax-free. 7 seconds.
Well done, you.
Thank you,
well
Alex and Connor and everyone who attended. I hope